Watch this short. This is a crypto token called Titan. It hit $64, then flatlines to zero in hours. $2 billion gone. Even the billionaire Mark Cuban lost money. This was Iron Finance, crypto's first massive bank run. And by the end of this video, you'll see exactly how belief alone can destroy a billion-dollar ecosystem. Iron Finance launched in 2021 as a partially collateralized stablecoin. Translation: a digital dollar that's mostly backed by real money, but not entirely. Think of it like a house with real bricks and a few pillars of confidence holding up the roof. The project grew fast on Polygon and Binance Smart Chain, locking in over $2 billion in value within weeks. Everyone was printing risk-free yields and believing they found the DeFi holy grail. The system had two tokens, Iron, the stablecoin pegged to $1, and Titan, the collateral token that gave it value. To mint $1 of Iron, you'd lock in 75 cents of USDC and 25 cents of Titan. If Iron fell below $1, arbitrageurs could redeem it for USDC and new Titan. Simple maths kept the peg until confidence broke. What no one realized was that this design relied on Titan's price never crashing. But on June 16th, it did. A few large holders pulled liquidity from the Iron/USDC pools. They redeemed Iron for USDC and Titan, then dumped the Titan token back onto the market. Titan fell from $65 to $30 in minutes. Traders panicked, more redemption minted more Titan tokens, which drove the price even lower. That feedback loop, print, dump, repeat, was a death spiral, or as analysts later called it, a digital bank run. Among those caught in the collapse was Mark Cuban. He'd supplied liquidity to an Iron/Titan pool, and his funds vanished along with everyone else's. He tweeted, "I got hit like everyone else." Cuban wasn't a developer or a promoter, just a believer in DeFi efficiency who learned the hard way what algorithmic confidence means. The project team insisted that it wasn't a rug pull. They called it a classic bank run on a partial collateral system. But that phrase did little to comfort thousands of people who watched their balance evaporate. Iron Finance proved that numbers on a screen don't equal stability. Its yield farming program offered 10,000% API because someone else was always the exit liquidity. When returns look insane, it's because the risk is too. The project's oracle lagged behind reality, feeding outdated prices that made things worse. Each redemption minted more Titan until the market was flooded with worthless tokens. A textbook cascade failure, mathematically perfect, financially fatal. But this wasn't the last time we'd see it. A year later, Terra's Luna would repeat almost the exact same pattern. After the collapse, Cuban called for stablecoin regulation. Define what a stablecoin is and what collateral is acceptable. Analysts from Frax and Terra warned that Iron Finance ignored basic safeguards. Do Kwon himself said new projects must balance algorithmic design with real collateral. Ironic words from the man behind Luna. Iron Finance wasn't a hack, it was a confidence collapse. Billions of dollars proved that DeFi's largest strength, autonomy, can also be its Achilles heel. If this story taught you something, smash that like button so YouTube knows people still care about learning from these failures. And subscribe for the next deep dive because the next collapse might already be brewing. Thank you all for watching.